Welcome to BD Daily Finance News Podcast, your daily briefing on finance and investing. It's 2026, January 15th, and today's market story is a three-way tug-of-war. AI chip profits, rising yields, and geopolitics pushing oil around.
So basically, semiconductors are flexing, bonds are judging, and oil is doing parkour. I'm ready. Hit me with the numbers, and please keep it human.
Human version is the only version. We'll do three stories: TSMC's record quarter, the market bounce with yields rising, and a Fed warning about independence. Then we'll tie it to oil's drop after signals the U.S. response to Iran may be on hold.
Great, because my retirement account needs a therapist, and my grocery bill needs an exorcist.
Story 1. Taiwan Semiconductor Manufacturing, TSMC, delivered another record quarter, with profit up 35% from a year ago, driven by strong demand for advanced chips tied to AI workloads.
35% profit growth is not a nice quarter. That's a my neighbor just bought a second yacht quarter. What's the simple finance behind why this moves markets?
It's basically like this. TSMC is a toll road for the entire tech ecosystem. If AI demand is real, the toll booth sees it first, because the chips have to be manufactured before the hype becomes revenue for everyone else.
So when TSMC prints a record quarter, it's like the cashier ringing up actual purchases, not just people walking around the store saying, "I love this brand."
Exactly. And for normal investors, the actionable takeaway is to separate AI beneficiaries into layers: chip makers, cloud platforms, software, and everyone else. When the foundry layer is growing profits this fast, it supports the idea that the CapEx cycle is still alive.
The AI boom isn't only memes and conference keynotes. There's a real invoice being paid somewhere. But does it mean every AI stock deserves a promotion?
No. It means you should watch margins and pricing power. If the upstream supplier is doing great, downstream still has to prove it can turn compute into durable cash flow. Also, concentration risk matters. One strong report can lift the whole complex, but it can also reverse fast.
Okay, but here's where my brain breaks. We also saw tech rebound while Treasury yields rose. Aren't higher yields supposed to be tech's kryptonite?
Often, yes. Higher yields raise the discount rate, which mathematically lowers the present value of far future profits. Growth stocks feel that first. But markets aren't one-variable equations. If earnings confidence jumps enough, it can offset the yield headwind for a day or longer.
So it's like my credit card APR went up, but I also got a raise. Still annoying, but I can breathe.
Perfect analogy. And for everyday people, higher yields can mean better returns on safer assets, cash-like and short-duration bonds, while also making mortgages and car loans more expensive. So the same move can help savers and hurt borrowers.
Speaking of rates and pain, I saw the quote from Chicago Fed President Austan Goolsbee. He said inflation could come roaring back if central bank independence goes away. That sounds like the plot of a disaster movie, where the villain is politics.
That quote matters because independence is credibility. Imagine your thermostat is controlled by someone who hates being uncomfortable for 5 minutes, so they keep cranking the heat, even if the room is already hot. Markets fear that if the Fed can't make unpopular choices, inflation expectations can unanchor.
So independence is like the adult in the room who says, "No, we're not ordering dessert until we pay the bill." And everyone boos, but it keeps the restaurant open.
Yes. If inflation roars back, it hits normal life fast. Groceries, rent renewals, insurance premiums, and wage negotiations. And in markets, it can push yields higher, pressure stock valuations, and complicate the path for rate cuts that many borrowers want.
Now let's talk oil. Crude tumbled after President Trump signaled the U.S. response to Iran is on hold. Oil is like that one friend who hears one sentence and immediately changes the entire group chat mood.
Oil prices often move on perceived supply risk. If markets think escalation is less likely in the near term, the risk premium can come out of the price. And because energy feeds into headline inflation, a drop in oil can slightly ease inflation pressure, though it's never the only driver.
So today's vibe is chips say growth is alive. Yields say show me the math. The Fed says don't mess with credibility. And oil says, I'm calmer, for now. That's a lot for one commute.
Quick recap. TSMC's profit up 35% supports real AI-driven demand. Tech can still rally even with rising yields if earnings confidence improves. And Fed independence is a key pillar for stable inflation expectations. Meanwhile, oil falling on an Iran pause can relieve some inflation heat at the margin.
Action steps for normal humans. Check your borrowing rates. Don't over-concentrate in one AI everything basket. And remember that energy prices can change your inflation story faster than your New Year's budget app updates.
If this helped, subscribe and share the episode. And leave a comment. Are you positioning for higher for longer yields, or betting that growth earnings like TSMC can keep carrying risk assets? We'll be back tomorrow with your next briefing.
And if your portfolio is stressed, just remember, at least you're not an oil trader with notifications turned on. See you next time.